Exchange traded funds are a relatively new type of fund. They're offshoot of mutual funds. They allow investors to trade index portfolios. I mentioned them previously. They have a lot of advantages. They trade continuously throughout the day. I probably should have mentioned this previously, but when you purchase um, a open-end mutual fund, the you purchase it during the day. Well, the value that you pay for that is not going to be set until the end of the day. When the mutual fund, the company calculates the net asset value. So the there could be potentially be a significant market move between the time that you purchased that investment uh, and the net asset value was determined. Uh, the exchange traded funds are traded on exchange. They trade continuously throughout the day. So when you make a purchase, you're gonna know exactly what you paid for that exchange traded fund. They can be bought and sold on a margin, so you can borrow money to invest. Uh, the taxes can potentially be lower. Um, the reason being is you can control when you buy and sell yourself as opposed to the mutual fund company making the decision. Um, Costs are much lower than on a typical mutual fund. Uh, Fees on a typical mutual fund probably anywhere from 50 basis points to 1%, potentially even more. Um, the a S&P 500 and exchange traded fund, probably 15 basis points is probably the maximum you would pay. So less than a quarter of a percent. There some of these funds have less than have fees that are 5 or 10 basis points, so very low. Uh, Potential disadvantages: there are certainly potential deviations from net asset value, but they're typically small. Um, you do pay a brokerage commission to buy an exchange traded fund, but brokerage commissions are typically very small, especially if you're using a discount broker. Figure 4.2 gives a breakdown of funds in ETFs. You can see the sectors: bonds, commodities, global and international equity, U.S. equity, sector and broad index. So there's a lot of choices. The the numbers are kind of on the side of this chart. They're kind of screwed up. I, the We have built millions of dollars invested here, and I think we just have a zero missing from the numbers. But you can see from in 1998 there was almost nothing invested in these types of funds. We go out to 2016 and there's you know, looks like 22 billion dollars invested in them, or 22 and a half, or no, I guess if we go straight across, it looks like total 25, sorry. But anyway, 12 and a half billion dollars in exchange traded funds. Go to the next page, get an idea of the size of the mutual fund market. The as we mentioned, 2.5 billion dollars in exchange traded funds. The 16.3 billion dollars invest in mutual funds. Those would typically be open-ended mutual funds. The closed-end funds and unit investment trusts make up a very small percentage of the market. This is mutual fund performance versus the broad market. They're using the Wilshire 500 index and comparing returns during given year. The thing to note here is, for the most part, mutual funds typically do not outperform the market. You see the blue line is Wilshire, and the vast majority of the time um, the Wilshire 5000 outperforms mutual funds. These are actively traded funds. The point being is that active management is very, very difficult, and there are very, very few people who do it well. And typically, if they are able to do it, somebody figures out what they're doing, and they are unable to do so for a long period of time. And we'll see this on the next chart. And I think some of this has to do with the growth of the mutual fund industry. And if we look at the chart on the next page, this is Burton Malkiel did a couple of studies in the 70s and 80s. He wrote a book called A Random Walk Down Wall Street. Basically, the idea is that you can't really predict the performance of a firm. So there is what we call persistence, which basically what persistence means is that a fund does well 1 year will continue to do well the next year. If you look at his 1970s study, it showed firms in the top half were more likely to stay in the top half than they were to fall into the bottom half. Bottom half performers were more likely to stay in the bottom half the following period. So this is some evidence of persistence. The 1980s, which was a period where we saw very, very large mutual fund growth, it's basically what we have is a situation where there's almost no persistence whatsoever. So you're a firm that's in the top half is almost just as likely to be in the bottom half, and vice versa during the 80s. So, sources of information for mutual funds. This is a chapter conclusion. Morningstar. As I mentioned, Morningstar is the Bible for mutual funds. They keep information on almost any mutual fund that you would want to buy. You can get a prospectus from the fund. You can literally go online, download those. I suspect if you wanted to ask them to, they would mail them to you. Yahoo Finance is a great source of information. The Wall Street Journal, Investment Company Institute, or www.ici.org. American Institute of Individual Investors. You can also get that information from brokers. If you're interested in investing in mutual funds or exchange traded funds, I would recommend that you don't go through a broker. You're just paying for. You can do the analysis yourself, and you'll be better off in the end.